If you owe taxes to the IRS and can't pay the full amount right away, don't panic. The IRS offers payment plans, also known as installment agreements, to help taxpayers pay off their debt over time. In this video, we'll walk you through the process of setting up an IRS payment plan step by step. We'll cover eligibility, the types of plans available, how to apply, and what you need to know to stay in good standing. Whether you owe a small amount or a larger balance, understanding your options can help you avoid penalties and interest. Let's get started by exploring what an IRS payment plan is and who can benefit from it. An IRS installment agreement is a payment plan that allows you to pay your tax debt in monthly installments rather than all at once. This option is designed for taxpayers who can't pay their full tax bill immediately but want to avoid more severe collection actions, like liens or levies. By entering into an installment agreement, you agree to make regular payments until your balance is paid off. The IRS offers several types of installment agreements, each with its own requirements and terms. Understanding these options can help you choose the best plan for your situation. Not everyone qualifies for every type of IRS payment plan, but most taxpayers with outstanding balances are eligible for some form of installment agreement. Generally, if you owe $50,000 or less in combined tax, penalties, and interest, you can apply for a streamlined installment agreement online. If your balance is higher, you may still qualify, but you'll need to provide more financial information. It's important to file all required tax returns before applying, as the IRS won't approve a payment plan if you have unfiled returns. Let's look at the different types of plans next. The IRS offers several types of payment plans to fit different financial situations. The most common are short-term and long-term installment agreement. Short-term plans are for those who can pay their balance in 180 days or less, while long-term plans, also called installment agreements, allow you to pay over a longer period, usually up to 72 months. There are also partial payment installment agreements for those who can't pay the full amount, and special options for businesses. Knowing which plan you qualify for can help you choose the right path forward. A short-term payment plan is ideal if you can pay your tax debt in full within 180 days. There's no setup fee for this option, but you'll still owe penalties and interest until the balance is paid. You can apply online, by phone, or by mail. This plan is best for those who need a little extra time but don't want to commit to a longer agreement. If you think you can pay off your balance quickly, this could be the most cost-effective choice. A long-term payment plan, or installment agreement, is for those who need more than 180 days to pay off their tax debt. This plan allows you to make monthly payments over several years, up to 72 months in most cases. There is a setup fee, which can be reduced if you apply online and choose automatic withdrawals. Penalties and interest will continue to accrue until your balance is paid in full. This option is suitable for those who need more time to manage their payments comfortably. If you can't afford to pay your full tax debt, even over time, you may qualify for a partial payment installment agreement. This plan allows you to make monthly payments based on what you can afford, and the IRS may eventually forgive the remaining balance. However, you'll need to provide detailed financial information, and the IRS will review your situation periodically. This option is more complex, but can provide relief if your financial situation is challenging. Businesses that owe taxes can also apply for installment agreements. The process is similar to that for individuals, but there are some differences. For example, businesses that owe $25,000 or less in payroll taxes can apply for a streamlined agreement. Larger balances may require more documentation and IRS approval. It's important for businesses to stay current on all tax filings and deposits to remain eligible for a payment plan. Before you apply for an IRS payment plan, gather all the necessary information. You'll need your Social Security number or taxpayer identification number, your most recent tax return, and details about your income and expenses. If you're applying for a business, have your employer identification number, EIN, and business financials ready. Having this information on hand will make the application process smoother and help avoid delays. The easiest way to set up an IRS payment plan is online through the IRS website. You'll need to create an account or log in with your existing credentials. The online application will guide you through the process, asking for your tax information, the amount you owe, and your preferred payment method. You can choose between direct debit, payroll deduction, or other options. Once you submit your application, you'll receive confirmation and instructions for making your first payment. If you prefer not to apply online, you can set up a payment plan by calling the IRS or mailing in Form 9465 Installment Agreement Request. When applying by phone, have your tax information ready and be prepared to answer questions about your finances. If you mail in the form, make sure to include all required documentation to avoid processing delays. The IRS will review your request and notify you of their decision by mail. Setting up an IRS payment plan usually involves a setup fee, which varies depending on the type of agreement and how you apply. Online applications and direct debit plans typically have lower fees. In addition to the setup fee, you'll continue to accrue interest and penalties on your unpaid balance until it's paid off. Understanding these costs can help you budget for your payments and avoid surprises. When setting up your payment plan, you'll need to choose how you want to make your monthly payments. The IRS offers several options, including direct debit from your bank account, payroll deduction, check, money order, or payment by debit or credit card. Direct debit is often the most convenient and can reduce your setup fee. Choose the method that works best for your financial situation and ensures timely payment. The IRS will ask you to propose a monthly payment amount when you apply for a payment plan. It's important to choose an amount you can afford each month, as missing payments can lead to default. The IRS may require a minimum payment based on your balance and the length of the agreement. If you need help calculating an affordable payment, consider using the IRS's online payment calculator or consulting a tax professional. Setting up automatic withdrawals from your bank account is the easiest way to ensure your payments are made on time. This method can also lower your setup fee and reduce the risk of missing a payment. You'll need to provide your bank routing and account numbers during the application process. Once set up, the IRS will automatically deduct your monthly payment on the agreed-upon date. Another payment option is payroll deduction, where your employer withholds your monthly payment from your paycheck and sends it directly to the IRS. To set this up, you'll need to complete Form 2159, Payroll Deduction Agreement, and have your employer sign it. This method can help you stay on track with your payments and avoid late fees. If you prefer, you can make your monthly payments by mailing a check or money order to the IRS. Be sure to include your name, address, social security number, and the tax year on your payment. Mail your payment to the address provided by the IRS in your agreement confirmation. Remember, payments must arrive on time to avoid penalties. You can also make IRS installment payments using a debit or credit card. The IRS partners with third-party payment processors to handle these transactions, and a processing fee applies. This option offers flexibility, but keep in mind that interest charges from your card issuer may apply if you don't pay your balance in full each month. After you submit your application, the IRS will review your request and determine if you qualify for the payment plan you've chosen. For most streamlined agreements, approval is automatic if you meet the requirements. For more complex cases, the IRS may request additional information or documentation. Once approved, you'll receive a confirmation letter outlining your payment terms. If the IRS denies your payment plan request, don't give up. The denial letter will explain the reason, such as missing tax returns or insufficient financial information. You can usually reapply after addressing the issue or appeal the decision. It's important to respond promptly and provide any requested documentation to keep your case moving forward. Once your payment plan is approved, it's crucial to make all payments on time. Missing a payment can result in default, which may lead to additional penalties or collection actions. Set reminders or use automatic payments to help you stay on track. If you anticipate trouble making a payment, contact the IRS as soon as possible to discuss your options. If you miss a payment or fail to meet the terms of your agreement, your installment plan may go into default. The IRS can then take collection actions, such as placing a lien on your property or garnishing your wages. To avoid default, communicate with the IRS if you experience financial hardship. They may be able to adjust your payment plan or offer temporary relief. If your financial situation changes, you may be able to modify your payment plan. The IRS allows you to request a change to your monthly payment amount, due date, or payment method. You can make these changes online or by contacting the IRS directly. Be prepared to provide updated financial information if requested. You're allowed to pay off your IRS balance early at any time without penalty. Doing so can save you money on interest and penalties. If you receive a windfall or your financial situation improves, consider making extra payments or paying off your debt in full. Notify the IRS when you make your final payment to ensure your account is closed properly. Even with a payment plan, the IRS continues to charge penalties and interest on your unpaid balance. The sooner you pay off your debt, the less you'll owe in the long run. Make sure you understand how these charges are calculated and factor them into your payment plan decision. If you're on an IRS payment plan and become eligible for a tax refund, the IRS will automatically apply your refund to your outstanding balance. You won't receive the refund until your debt is paid in full. Plan accordingly and don't count on receiving a refund while you're still making payments. Generally, entering into an IRS payment plan does not directly affect your credit score. However, if your account goes into default and the IRS files a tax lien, that could appear on your credit report and impact your score. Staying current on your payments is the best way to protect your credit. Once your payment plan is approved and you're making payments, the IRS generally pauses most collection actions, such as wage garnishments or bank levies. However, if you default on your agreement, these actions can resume. Keeping up with your payments is essential to avoid further collection efforts. The IRS generally allows only one active installment agreement at a time. If you incur additional tax debt while on a payment plan, you'll need to contact the IRS to adjust your agreement. It's important to stay current with all future tax filings and payments to avoid complications. If you move while on an IRS payment plan, update your address with the IRS as soon as possible. This ensures you continue to receive important notices and correspondence about your agreement. You can update your address online, by phone, or by mailing Form 8822. Good communication with the IRS is key to maintaining your payment plan. If you receive a notice or have questions, respond promptly and keep records of all correspondence. If you need help, consider reaching out to a tax professional or the IRS Taxpayer Advocate Service for assistance. Creating an IRS online account gives you access to your payment plan details, payment history, and outstanding balance. You can make payments, request changes, and view notices all in one place. This convenient tool helps you stay organized and in control of your tax obligations. If you're unsure about your options or need help setting up a payment plan, consider consulting a tax professional. They can help you understand your eligibility, complete the application, and negotiate with the IRS if needed. Professional guidance can make the process less stressful and help you avoid costly mistakes. The IRS Taxpayer Advocate Service is an independent organization within the IRS that helps taxpayers resolve problems and understand their rights. If you're having trouble setting up a payment plan or dealing with the IRS, the Advocate Service may be able to help. Their assistance is free and confidential. When setting up an IRS payment plan, avoid common mistakes like missing payments, failing to file future tax returns, or underestimating your monthly payment amount. These errors can lead to default and additional penalties. Stay organized, keep accurate records, and communicate with the IRS if you run into trouble. Throughout your payment plan, the IRS will send notices and letters about your account status, payments, and any issues. Read these carefully and respond promptly if action is required. Keeping track of your correspondence can help you avoid misunderstandings and stay in good standing. Your IRS payment plan ends when your balance is paid in full or if you pay off the debt early. The IRS will send you a confirmation letter stating your account is settled. Make sure to keep this letter for your records. If you have questions about your account status, contact the IRS for clarification. Keep copies of all payment confirmations, IRS letters, and your payment plan agreement. Good record keeping can help resolve disputes and provide proof of compliance if questions arise. Store your documents in a safe place and consider keeping digital backups for easy access. If you find you can't afford your monthly payments, contact the IRS immediately. They may be able to adjust your plan, offer a temporary delay, or discuss other options like an offering compromise. Ignoring the problem can lead to default and more serious consequences. An offering compromise is an IRS program that allows you to settle your tax debt for less than the full amount owed if you can't pay in full or through a payment plan. This option requires a detailed application and financial disclosure. Not everyone qualifies, but it can provide relief for those in serious financial hardship. In some cases, bankruptcy can discharge certain tax debts, but this is a complex area of law. Not all tax debts are eligible for discharge, and bankruptcy has serious long-term consequences. Consult a bankruptcy attorney or tax professional before considering this option. The IRS website offers a wealth of resources to help you understand and manage your payment plan. You'll find forms, calculators, FAQs, and contact information for assistance. Take advantage of these tools to stay informed and make the best decisions for your situation. Many taxpayers have questions about IRS payment plans, such as how to apply, what happens if you miss a payment, or how to change your plan. The IRS provides answers to common questions on their website, and tax professionals can also help clarify any concerns you have. To recap, setting up an IRS payment plan involves determining your eligibility, choosing the right plan, gathering your information, applying online or by mail, and making regular payments. Stay organized, communicate with the IRS, and seek help if you need it. Following these steps can help you resolve your tax debt and regain financial peace of mind. Dealing with tax debt can feel overwhelming, but the IRS payment plan process is designed to help you manage your obligations. By understanding your options and taking action, you can avoid more serious consequences and work toward financial stability. Remember, help is available if you need it, and taking the first step is often the hardest part. You've got this.